Today is Monday, January 22nd, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADM Investor Services, and Alan Bush, ADMIS's Senior Financial Economist. Steve, let's start with the grain markets this morning. Can you please share with the viewers the current technical signals in the corn, soybean, and wheat markets?
The corn market fell down from the July highs to a recent low around 340 in the March. We've been trading 345 to 355 in a sideways trade, and the market is expecting to see the market continue into the sideways trade. The bean market's been kind of interesting in that we broke last July to a low around 950, rallied almost to $10, broke to 940, and now we're rallied about 40 cents in the last few days. The market's trading weather in South America, and we doubt that the market can trade over $10 in the nearby futures because there's just too much supply in the world, but the funds are short, and they may cover shorts if the weather in Argentina continues to be drier than normal. The wheat market was like corn, broke from the July highs. We made new lows recently around 410 on the March. We rallied about 15 cents on some dry weather in the southern plains. Again, the funds are short, almost a record amount of Chicago wheat, and it's going to take a weather problem to move the market a lot higher in the wheat market.
Let's expand on the weather a little bit, Steve. What is an update for us on the South American weather, both in Argentina and also the weather here in the U.S.?
In South America, it's gotten interesting, and because in the last 3 months, Argentina's received about 50% of their normal rainfall. Their corn crop is rated about 50% poor to very poor, and only 10%, 11% good to maybe good. None of it is rated excellent. And so we're getting kind of in that growth period in which it's not pollinating yet, but they need a rain. And the forecast is to stay dry over like 2/3 of the country. In Brazil, central Brazil has been receiving a lot of rain, and it's slowing the harvest of the soybean crop and the planting of the second corn crop. And 2/3 of their corn crop is that second crop. Northern Brazil's actually been dry, and it's affected the coffee market, and we'll just see how all this kind of plays out. Market still thinks that the Brazil soybean crop will be bigger than what the USDA is saying and offset what's happening in Argentina, but the funds are adding a little weather premium. As far as the U.S. is concerned, we have La Nina, where it's wet and cold across the northern part of the country and mostly dry across the southern part of the country, and that's supposed to continue through the month of February. So we might get a little bit of a pop in Kansas City wheat if that dryness continues in Kansas.
Many of our viewers read Dave Hightower's analysis. What is Hightower currently saying about soybeans and wheat?
His campaign trade is he wants to be long Kansas City wheat in the July and short Chicago wheat, thinking that this weather phenomena could actually allow KC to gain on Chicago. And the fundamentals to him in soybeans are still bearish, and he wants to be long May puts.
Last week you spoke at some farmer meetings in Iowa. What specifically were the farmers talking about?
The farmers really had more questions than answers. The crop prices right now are below break even for a lot of farmers. So the first thing they want to know is what would it take to rally the market? And they all kind of said the same thing. It's going to be some kind of weather phenomenon. And they all hope it happens everywhere but the state of Iowa. And as far as marketing is concerned, the market perceives that a 10 to 15 cent rally in corn, maybe a 40 or 50 cent rally in beans, would encourage them to sell some cash.
Alan, shift over to financials here. The U.S. government shutdown has now entered its third day. How will this affect the economy and any Federal Reserve policy?
Well, first of all, the shutdown should have only a minimal negative effect on the economy, as it has in the past. And as far as Fed policy, I really don't think it changes anything at all. The Fed is still on track to raise rates at their March meeting. And it also appears that there are 2 to 3 rate hikes factored into the situation for this year. So in fact, it's only 2.5 are factored in. So we're going to have 2 to 3 rate hikes, but nothing has really changed with the shutdown.
Another item that may be of note this week is the European Central Bank's policy meeting on Thursday. How do you think this meeting will affect the euro currency?
Many traders are not looking for any surprises to come out of this meeting. However, There is a slight chance that the ECB might talk about withdrawing some more of their accommodation. That would be a bit of a surprise, and that would be bullish the euro currency, as interest rate differentials in that case would tend to be more friendly for the currency of the Eurozone. My feeling is that the euro currency is likely to continue to advance, while the US dollar will, I believe, continue to come under downside pressure.
Any change to your bullish sentiment in the stock indexes as a result of the government shutdown or anything else?
None whatsoever. Nothing has changed at all. The shutdown, as in the past, will only temporarily get in the way of a bull market. And in fact, just today, we're already seeing new historical highs in the S&P and the NASDAQ. So just a very minimal psychological negative impact from the shutdown, if that at all. So any breaks should be used as buying opportunities. There is a lot left price-wise and time-wise to the upside in stock index futures.
Let me throw this last question out to both you. Anything else traders should be keeping an eye on? Industrial metals, energies, perhaps softs?
My belief is that the industrial commodities will continue to advance. Crude oil is likely to remain in a bull market. Copper is in good shape. Other commodities that we are looking at also suggest higher prices. So industrial commodities should advance in price as one would expect in a recovering and expanding global economy.
In the most recent China GDP data, it was better than expected, so that should help industrial metals, it should help energy markets. I think one market that continues to scream higher is cotton, and you have a lot of the mills in the United States short the cotton market, so every time they come in, they cover that short. It just adds fuel to the fire.
What about the news we've had over the past couple of weeks about China and ethanol? Is that still something that's out there, that China's going to produce more ethanol?
Many of the people close to the Chinese feel that this is a policy about pollution and about improving the lifestyle of their people. So they are building ethanol plants. They'll continue to build ethanol plants, and they will blend 10% ethanol into their gas mixture, which will add to the demand for corn.
Great. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.